Hi, Neil Rose here with an investment strategy update, especially in the context of the Russian invasion of Ukraine. You've seen a lot of movement in the portfolio, I know, even before the news of invasion or the run up to invasion. It hasn't changed much in terms of the things that we're moving into or the components we're adding to portfolios. If anything, Russia just accelerates the need for those kinds of things. More infrastructure, more commodity exposure, more exposure into industries and sectors and asset classes that frankly have lagged for quite some time. We talked about this in January's presentation. Still think it's a good idea. And I just thought I'd spend about 10 minutes breaking down some thoughts and assumptions and really articulating that there's not a lot we know about. Don't know how this is going to end, but we can sort of pre-think some of the ramifications for the invasion and its effects on prices and capital markets. And we just want to keep things covered in terms of not being exposed to unforeseen outcomes. And even with things that markets are still not really addressing, like inflation, is it for real? Or will investors continue to pay 40 times earnings for certain stocks like tech stocks or even 50 times sales stocks? There's still a lot of those, even though it seems like the leadership for quite some time has really started to break apart and rotate. So just very quickly, so all things Russia, a lot we don't know, and not going to pretend to be some political or military strategist, but obviously this is something worth watching, especially since it's a global military power, and we don't know how this ends. Putin does seem to be somewhat pot committed, and this might not be a short theater for war, but we want to assume that this won't be the quick, whatever way it turns, Ukraine or Russia truly takes over. We don't want to assume one event or the other. We want to sort of think worst case scenario in a lot of ways, because that makes for more robust portfolios. Markets are down. S&P's down 12%. NASDAQ down more. That NASDAQ underperformance just continues from even when we talked in January. Prices are still very high. I think 5 out of 10 NASDAQ stocks are down more than 50%. Our exposure to anything tech has been more in the high market cap, higher quality, that even as the NASDAQ broke apart, continued to outperform. Now it seems like these sort of champions are being shot, the generals are being shot now, and we have reduced exposure. We haven't exited completely because some of these are really great companies we want to hold indefinitely. I think a small position in things like a Microsoft or a Google make a lot of sense in the context of a diversified portfolio on a long time horizon. But our exposure is certainly not overweight or even equal weight. Tech is still far and away the largest sector in the S&P 500, and for us, technology isn't even the biggest sector, just among our equity holdings, much less the other asset classes that we have and cash in portfolios. We do want to avoid this, I think, a dangerous narrative, which is war is always good for stocks. I'm seeing charts like this float around, and a lot of strategists say because every time someone invades someone, markets go down, but it's very temporary, and then a stock market rip roars from there. I don't want to assume that. I don't think all wars are the same. Not all wars have the same ramifications for global demand and supply for commodities. Most of these wars you see don't involve serious nuclear threats or the existential threat of World War III. So we're not going to assume this is good or bad for markets in general as a whole. I will say we have started to question markets as a whole and the economy just because of the long run, the very high prices that benefited from cheap and cheaper capital. When interest rates are zero or near zero, people are willing to pay a lot for something that offers any prospects of growth or income. The Fed wants to raise interest rates, and so all things equal, the valuations, the PEs have to come down in a lot of parts of the market. We don't throw a recession off the table. I mean, we all know a recession is a 100% guarantee at some point in time, I'm noticing nobody's talking recession in the short to medium term, though. Even as interest rates increase, and then with Russia and this narrative about, oh, this will jolt the market and production back to life, or at least keep it going at great guns. I'm not sure. This is over time. This has been a fairly reliable indicator, the yield curve. And in short, when the yield curve inverts, specifically the 2-year Treasury yield and the 10-year, it usually represents a harbinger for recessions. Now, the yield curve is not inverted yet, but this is something we're watching pretty closely. I'll sort of repeat a thesis from January and even before that, which is we don't want to bet or forecast where inflation is going to be. And luckily, a year or two ago, it didn't matter what your forecast was because you had really good cause to sort of have things that benefit from inflation because it's somewhat of an asymmetrical bet, meaning interest rates can only go to zero. And if you believe the Fed will do all that it can to prevent absolute deflation through money printing, then it becomes somewhat asymmetrical. And the risk to money printing and increasing deficits and deficits financed by money printing is inflation. Money printing and deficits work so long as the money holds its value. But what if it doesn't? So we ask questions like that and say, well, you sort of get a free option on inflation. With the whole world concerned about deflation and downward prices and stock market crashes, there are no real concerns about the money not keeping its value. And that's what inflation is all about, money not keeping its value. Inflation is up. We don't want to assume it's transitory. That seems to be consensus. You almost care about where things are going because if you have a diversified set of assets that can do well or even give great performance if things go one way or the other, i.e. higher inflation, then we should be just fine, especially given our short and long-term objectives of preserving not just capital, but preserving purchasing power and achieving some growth over time. Just a reminder that inflation is pervasive. We're looking at inflation in places we never thought of before. It's not just oil, gas, commodities. It is in real estate. It's used cars. I mean, of all things, historic run in used car prices, especially those cars under 20 grand. It's amazing what people are willing to pay now for cars. And there are very specific reasons for that, of course, but just an example of inflation being more than just food and energy. And I had noticed a lot of economists kind of write off inflation because they say, well, it's all food and energy. Well, no, it's not. It seems to be in a lot of places, labor, goods. We hear our companies on the conference calls and they talk about inflation and their supply chains, their higher, could be taxes, could be higher transportation costs, et cetera. So inflation is here. How long, we don't know, but again, we don't want to be vulnerable to it. We started rotating and having some commodity exposure months ago and started in the form of metals and agricultural items. The last component to our addition has been more infrastructure and energy. I've always been reluctant to invest in energy, all things equal, because too many moving parts, and let's be honest, it's based on where oil and gas prices will go, which is not something we or anybody else can do in a reliable way. However, with Russia, it seemed to accelerate that need for more commodity exposure, and especially given Russia's impact on global supply, especially to important places like Europe. So we've accelerated our buying into places like this with high quality operators. And like commodities as a whole, oil and gas, if one were to add exposure, it's hard to argue that this is not a good time, especially given the 10, 11 years of underperformance. But we're watching this. Germany halted what would be the third major pipeline into Europe and the only one that would go directly to Germany. Most of that gas comes through Ukraine. And obviously, so there's a tie there between, I'm guessing, Russia's calculus for invasion and those very valuable pipelines. But that project's halted, and so very little wonder why prices are increasing. There's not just these kind of simple variables that you can point to on a map like this, but just the existential threat of war and global conflict, and on top of what's been years of underinvestment in oil and gas as the prices have gone down. It just seems a good bet to have a portion, not huge. Oil and gas as a portion of the economy and markets, not actually not that big from a value standpoint, at least markets wise, but it is something that affects everything, as we know. So having a component, these beaten up operators, and yet big low cost producers that have huge accelerating earnings now and going forward. We don't know what the earnings will be, but we know what they were modeled at with oil at $50, $60, $70. Well, now we're talking $120, $130. There'll be some huge surprises. These companies almost always have really high dividend yields. We only expect the dividend payments to increase, with this windfall they're getting. Brent crude is at $130. West Texas Intermediate's a few bucks below that. We're getting to the old highs of 2011 and don't know what happens. It could very easily go higher. I don't want to be kind of stuck in this mindset that 140 is a ceiling. It could be the new floor for some time if this crisis gets worse. Other commodities also could have consequences or contingencies. Wheat. The last time wheat flew like this, you had the Arab Spring. The Middle East is a major wheat consumer. It is the staple of daily life. And I don't want to assume that the Ukraine crisis, which is a big crisis, especially if you're talking about the possibility of World War III, but it being the only crisis. We could have another crisis in the Mideast or elsewhere as food prices increase and populations get angry. Even with all that inflation I mentioned, the consensus is still pretty, I would say, optimistic about long-term inflation expectations. If you see, they haven't moved much over time. The economy still thinks inflation will be about 2%, and the Fed and all the other central banks of the world will be, perfect in terms of their goal of keeping inflation low and steady. I'm not sure that can happen, especially as you have more trade-offs now in policy between helping the economy and jobs and yet, especially in the face of future recession and war, and keeping their inflation mandate. It seems like central banks will have to choose at some point in time. It's not as easy as it was in the past. The Federal Reserve balance sheet just keeps increasing. I still remember after the financial crisis when the Fed balance sheet went from $800 billion to $1.5 trillion, and then to $2 and the $2.4 trillion, and it was supposed to taper off from there. And even as the economy grew slowly, and the stock market grew a lot, the Fed was very reluctant to sort of trim the balance sheet and take away all the dollars that they had printed and put out into the marketplace. And then with COVID, we had another jump in the balance sheet. This just means that they printed money and bought bonds, treasuries, mortgage-backed securities, even corporate bonds, flooded the economy with even more cash. And prior to the Russian invasion, it was quite the guarantee that the Fed would spend months and maybe even years raising rates, taking that liquidity out, and maybe doing it until they really cracked the stock market or precipitate a recession, as has been the case before. I wouldn't want to be Jerome Powell, the chairman of the Fed. Very difficult job, but more reasons that one needs to think about inflation and diversification. Hard decisions with big consequences, and we don't want to be vulnerable to either. This is a slide I used in January about that diversification and arguing that if one were to get off the big tech train, or at least not be as exposed and diversify in other things, there probably hasn't been a better time to do that. Commodities relative to equities have been years and over a decade underperformer, and that commodities and equities leadership, it goes in cycles, multi-year cycles. And looking at something like this, can't help but wonder, given all the wealth and high prices in stocks, real estate, etc., eventually some of that has to affect commodity prices, and we just see this huge gap between the price of financial assets and the price of commodities. And so, add some exposure and continue to do so. It won't be a big portion of the portfolio or even the big portion of the equities, but we want to position size it right so that it can add value, meaning it can add diversification, add more robustness to shocks in markets and the economy, and hopefully also get higher gains over time. We certainly will get more income over time, as a lot of these securities have above average dividend yields that should only grow as they get this windfall from higher prices. And this helps me kind of think about the equities. So as I sort of see it, we have four themes going. One is sort of evergreen. All things equal, we love investing in good businesses that are hard to kill, companies with very predictable runways. They do something special. They offer value. They're run by honest, able, smart people with a fiduciary mindset. And a portfolio of those should be just fine over time. They'll be volatile as the stock market as a whole is, but maybe less risk than the stock market, where over time most companies don't perform and they even die. But a lot of these new additions are somewhat rule breakers to that. I just thought I'd put all these new companies that you're seeing, and a lot of them are small positions, and you see many trades, if only because not just the number of new names, but we've been just buying in tranches, in small bits, with trading costs low and free. Nowadays, it seems smart to sort of limp in and not buy everything at once, and then be emotionally tied to that price that you bought at. So we've been limping in, and I think that's an easier path to being approximately right in what you're trying to do, and not get whipsawed or shaken out of the tree because you bought something and a week later it's down. So going back to this, you have the long-term champions in yellow and sort of long-term growth, or reasonably high probability of growth. And then we have these inflation beneficiaries. It started with the metals and fertilizers, seeds, and then lately it's been more oil and gas. And you'll see some overlays. So the blue side is just looking at yield. It's been a while since stocks have had more yield than bonds, investment grade bonds in general. That has only seemed to increase even as interest rates have increased because of the types of names we are buying. So we have these high dividend yields, meaning that they're above market, the 3-4% type yields. But they also include companies that on the surface look to have a modest or even below average yield. But I put them in this basket because they either have dividends that are not counted by data sources, like take a Costco, which last year did a $10 special dividend, and every couple of years will do probably about that or more. And they do a quarterly dividend that increases at a pretty high rate over the years. But you look at Costco stock, it seems to have a low dividend yield, but that's because the stock price keeps rising. So the best dividend stocks are not the 4 or 5% yields that are from companies that don't grow much, have lots of debt, telecoms, etc. They are good and growing businesses where the increase in the dividend payment just compounds at a high rate, and the cash that you get, the real income you get, surpasses the high dividend, no growth companies pretty quickly. Again, we don't notice that on the surface because every day we see a dividend yield that's adjusted for the stock price. And so a lot of these companies, the stock price goes up. So the dividend yield doesn't look good, or the dividend itself doesn't look good. But if you compare these to the dividend or the price that you bought at and the dividends that you're receiving today, these are really great dividend stories. And so it occurred to me we have a lot more of them than I thought, and the portfolio yield as a whole has gone up and probably will continue to do so in the foreseeable future. And this is a good thing. Again, who doesn't want income? Who doesn't want dividend growth? And we've always argued that bonds are not really for yield. They're for diversification against the stock market. It's a way to play lower interest rates or deflation. But so we have the champions, the inflation beneficiaries, the high and or fast-growing dividend yields, and most of these companies overlap 2 or more categories. And I think that's great. And then we always have a couple of special situations. They could be direct hedges. We've come back into defense after a hiatus out of defense stocks. These are bona fide long-term growth, really well-run companies, profitable, unfortunate as that may be, but especially with the prospect of war. It just seems to make sense to have defense stocks as a component. And then we have our specific stocks that are, we call them alphabets. They are just stocks that we think, in the context of a diversified portfolio, these are good shots. Even more, maybe more speculative, but they are good risk rewards, and with limited position sizing, they don't increase the risk of the portfolio as a whole. In fact, they might do the opposite. So anyway, these are the names. If you have balanced multi-asset portfolios, like virtually all clients of ours do, this is your equity portfolio by and large. And just this is something I have to refer to a lot because we don't want to take our eye off the long term. Long term is, so long as one isn't vulnerable to short term moves, one can afford to take a long term view and with not only withstand volatility, but maybe embrace it. I think it is true that volatility and even discomfort are the price of long term gains. Yet we're human, so we don't want to put ourselves in a position where we have too much in stocks or anything, because one, that's stressful and that doesn't necessarily increase our quality of life. But the problem is with the argument about stocks for the long term and all that is that you have to stick with it. And number one, which most people don't if they're have too much stocks and they're looking at a portfolio that's down 30 and 50%, and it's only a matter of time before the market does that again. And number two, even if they can hang in there with the volatility, they just never know when they might need the money. So there might be a great acquisition or a need for money or an expense that was unforeseen but large. Well, you don't want to withdraw that money from a portfolio that's down a whole bunch. So we have to balance asset allocation and diversification and conservatism with this concept that you have to have some volatility or things that are inherently more volatile in order to satisfy longer term goals and even be more conservative in the context of the long term, i.e. making money and beating inflation and increasing one's financial margin of safety. It's a neat illustration I saw on the internet. This is great. In theory, why are we doing this? It's for compounded returns. Compounding returns is a massive force of nature. You compound anything at a rate, whether it's 2%, 5%, 7%, 10%. Over time, that chart looks like this. It gets exponential because every compounding period means more and more money has been made. I'm quickly thinking of a stat I read. It's hard to believe. Warren Buffett wasn't a billionaire until he was 65. And now his fortunes, meaning his portfolio, fluctuates by more than $1 billion on any given day, most days. And that's just compounding. The percentages haven't necessarily changed. It's these percentages are applied to ever bigger amounts of money. So that's the theory, but things don't go quite like that. They go more like something on the right where you get to the same place or you get to the place that theory says, but it's a rockier road. And so we just have to make sure we, more than anything, are always attuned to temperament and our, in our own psychology and our own biases and our own demons. And anyway, but this is something I like to hang on a wall. I think it's a good reminder. And so with all the down talk in all things big tech, I just thought I'd want to clarify this is not a bullish take on big tech or stocks in general. And much like the other components that we've recently added, we still think you need a good, maybe even a relatively larger percentage in things that are these long-term champions, these things that compound, these things that are fairly macroeconomically resistant. They do something so special and offer so much value to customers that recessions are pretty much a non-factor for them. This is a company we trimmed earlier this year. It's a company I admire. There's a lot I don't like, just maybe as a consumer, and there's certainly some societal questions that need to be answered in terms of data and all that. But I just use this as a case study in terms of a reminder that if you get the business right and you get the growth of the business right, the market eventually follows. So this is paraphrasing an old Buffett quote, which is the stock market is a voting machine in the short term, but a weighing machine in the long term. And you can see on a longer term chart like this, as the earnings of a Google have increased and have gone parabolic, because again, you're compounding earnings and it goes up, well, the price generally follows. And with a really great business, your ins are when there's a dislocation between price and value. And even those earnings trends. So interesting to see what Google does from here. If it continues to slip, Google's about a 20 times multiple, which is probably cheaper than it's been a long time. Part of that's that recent drop, but most of that is the earnings, just continue to increase at a pretty huge clip, especially the last few years. I mean, this is COVID. This is all things that killed the earnings of so many industries, and yet you have these companies and industries like Google where they're quite impervious to things. So, this gets any lower, it may add to it. And over time, again, for our risk and reward objectives, especially over time, you need things like this in there. You need these outliers. You need these super growth stories. And, and so, we won't abandon certain ones. We sold out of Apple, for instance, but out of all the big tech companies, that was just one we didn't feel as good about. It's more expensive than a Google, and frankly, we think they have more uncertainties and risks in a lot of ways to their business model. So, for the trimming exercise, and Apple goes out, trim a little bit of Microsoft, a little bit of Google, got rid of a couple other names, but, we don't want to abandon this name, at least not yet. You never know. Things could change. There could be huge game changers that apply to Google. It is arguably too successful a business and business model where governments do finally sort of collude to crush them. We have to be careful of that. But what we don't have to be as mindful about is competition, direct competition. They really don't have it. And a lot of our companies that do what they do, Costco, Amazon, they don't have competition. Short, medium term is not the risk. These are usually other things, and they typically result in good risk-reward ratios. I mentioned growth as a component to conservatism over time, but also have to remember these dividends. And yes, they're now a higher source of income than bonds, and they've been that way for some time. But just a reminder that dividends have been, which is to say stocks have been, arguably the best inflation hedge you can have over time. These are, in a way, as a portion of a whole picture of net worth, these are no-brainers. Having companies that can continuously pay higher and higher amounts to investors, and a good complement to those companies like a Google and Amazon, where they not only don't pay a dividend, they shouldn't, because they're better off reinvesting in their businesses for even more growth. But eventually all companies can and should be a dividend company. At some point, Google won't have the need for all the billions of dollars it makes in earnings, and they should pay it out in dividends. I would actually argue that's where they're at now, the $100 billion plus of cash they have. They should be sending checks, and they might. And they will, I assume. Much like Microsoft spent most of its life not paying a dividend, now it's a huge dividend growth story. But again, dividends are good, and the chart on the left I thought was useful. Dividends have quite recovered from the COVID crisis, and I think over time it's kind of safe to assume that more of these dividend payments are coming in higher amounts. Interest rates have increased. Now they're still fairly modest for historic standards. Still very underweight long-term bonds, treasuries, investment-grade bonds. The yield's too low. You need a little bit, because they do have some usefulness if there is a sudden change in perception, especially with things like recession and things like that. These yields can fall quite a bit in a short period of time, and therefore the prices rise. But we're going to keep our eye on the 10-year Treasury yield. This seems to be a pretty big determinant of where a lot of asset classes will go, especially like big tech. If this interest rate keeps increasing, people are going to be less willing to pay high multiples for stocks in general, but technology, et cetera. So we're keeping an eye on this. And if it goes up, we'll continue to add to it. Don't want to write off a good ending, or at least a benign conclusion, or a relatively benign conclusion to the Russian-Ukraine crisis. Someone asked, if Putin just sort of retreated or was, internally taken out, or lost his power, or whatever, or what would happen next, I would have to assume interest rates would increase instantly. So many threats off the table. Now markets can maybe listen or think about more, inflation, higher rates, growth, the Fed being now able to raise rates as it wants, which is a lot. That will not do so well. Long-term bonds, banks and other industries that benefit from higher rates, and so they'll probably do well. So, we could see another sort of asset shift as it is. But right now, no direct bank exposure. But we'll keep our eye on all this. Write me or call if you have any questions. Sorry, this went way over what I anticipated, but I hope all's well, and we'll talk soon. Thanks.